Hey everyone, it's the team at Mission Financial Planners. We are here today to talk about the new tax bill for 2025 and what that might mean for you. We have a lot of ground that we're going to cover today. We're going to go somewhere between 40 and 50 minutes, so we'll try to keep it kind of moving. You're going to have questions as we go. Feel free to ask those questions in the chat. Feel free to put them in the Q&A. We'll do our best to answer them as the presentation is ongoing. In addition to that, if you have follow-up questions that you want to have a deeper conversation with, make sure you reach out to me, Jason, or Ken. We're happy to schedule some time to meet with you. This morning session that we ran, we had at least, I'd say 7 or 8 people reached out to us afterwards with questions. Please feel free to do so. Given that it's 8 o'clock Central Time, we might not respond tonight for those follow-up requests, but you'll definitely hear from us tomorrow if you don't hear from us tonight. So I'm going to share my screen and we will get started. So what the tax bill might mean for you, that is really the big question. So again, we're Mission Financial Planners. Some disclosures for you. While we do help everyone with tax planning on a regular basis, we do not provide tax advice. If you're looking for actual tax advice, you'll need to speak with a CPA, a tax attorney, or an enrolled agent. But the reason we're talking about the tax bill now is because it was signed into law on the 4th of July this year. In May, the House passed their version. June, basically, you saw the House and Senate and the president negotiate back and forth to try to figure out how, what it was really going to look like. And then they came to an agreement on the 4th of July and it was signed. So what does it do? It extends the 2017 Tax Cut and Jobs Act and essentially making it permanent. One thing I do want to touch on in terms of permanent versus temporary, we'll get into this more in a little bit. Permanent just means that it doesn't expire. Doesn't mean that Congress can't change it. Doesn't mean that a future administration, a future Congress won't change it. It just means that there's no actual end date for it. Some of the provisions in the new tax bill are designed to expire, so those are temporary. We'll talk about those. You'll see you'll see it clearly called out as we go through it. It does expand deductions for families and seniors. There are some new savings accounts for children, and then there's some tax relief for workers, and it does also cut some federal spending. Like we said, some of the provisions are permanent, some are temporary. We will go ahead and get through those as soon as we can. So, big question a lot of people had. What about the income tax rates at the federal level? And of course, this is at the federal level. Most of the people on today's call are in California. Your state has its own tax system. State of Texas, of course, there is no state income tax. This is at the federal level. Income tax rates, TCJA extended permanently. Okay, those lower brackets that were put in back in 2017, they're going to continue indefinitely. This prevents the automatic increase that a lot of us were concerned about that was scheduled to happen on January 1st. The standard deduction also went up from 29,200 for joint filers to 31,500 single. You can see the numbers there as well. And seniors now have an extra $6,000 that they can deduct as well. So there are some phase outs that begin at the numbers that you see on the screen in front of you. But key thing is that is in addition to the current age 65 deduction, and it is $6,000 per filer who is age 65 and older. This is one piece where we will provide a little commentary on this. You may have seen stuff come out from the Social Security Administration saying, oh, they lowered the taxes on your Social Security income while you're in retirement. That actually the way the tax rate on Social Security or what amount of your Social Security is subject to federal income taxes, the way that's calculated, that formula did not change. So you still have those same brackets you're looking at in terms of, hey, is only 85% of my Social Security subject to income tax? Is only 50%, or is none of it subject to federal income tax? That $6,000, if there's a married couple, that's an additional $12,000 deduction on top of the already available senior deduction. Could help offset some of the income taxes you're paying in that regard, but the actual way Social Security is calculated from a tax standpoint did not change at all. Alternative minimum tax, the relief was made permanent. Those exemptions are now permanent. Jason, do you want to take a couple minutes and talk about this? Because this is something that will affect people who have pretty strong income.
Thank you, Matt. Yes, this is a very huge thing for people that have strong income and or are doing tax strategies like typical Roth conversions that we see. So with the alternative minimum tax, the most important thing is the phase out limit, right? So there's a limit where they say if you reach this limit, you're no longer eligible for the exemption, if you would. But the limits are set really high. So the single taxpayer limit is 626,000 plus, and the married filing jointly is over 1.2 million for the income limit. So unless you're over those thresholds, then go ahead and do your Roth conversions. It's not going to be an AMT that you're going to be looking at, which is great because pre-TICHA tax, the AMT was not that big. It was very short scheduled, and you would quickly get into an AMT situation on a Roth conversion.
So for those higher income earners, this is going to save them some tax dollars.
Yeah.
Yeah, absolutely. Some family tax benefits. You can see the child tax credit went up to 2,200. That is temporary. It expires after 2028. It goes back to 2000. The newborn Trump accounts. So these are for children born between 2025 and 2028. There's a $1,000 federal deposit for newborns. Parents can contribute up to 5,000 a year after tax, and you can use it for education, job training, a first home, basically, or after age 30, anything. Um, this is not like a 529 though, or an IRA. This is not tax deferred. This is not tax free when you use the money for something else. These accounts are something that will be subject to taxes as they grow. What these changes mean is, hey, if you're a family with qualifying children or you have kids who are having those families with qualifying children, you're looking at some potentially higher refunds. People who are having kids over the next few years, so a little more financial support. But the qualifications were also tightened up a little bit for the child tax credit and for the newborn aid as well. Okay, retiree and senior planning, how that $6,000 senior deduction works. The phase out again begins at 75 or 150,000. Jason and Ken, do you guys want to talk a little bit about how you see this playing out for a typical client?
Yeah, so where it really starts is just an increase in that standard deduction. And so if you were looking to do Roth conversions or just having just some tax relief, here's an extra 6 grand. Now, the thing is that this is one of those temporary measures. I think it's scheduled to phase out after 2028. So it's one of those things that you might get a little comfortable with when paying your taxes that on the other side of this, if it's not extended, that might come as a sticker shock. But while the sun is shining, make hay. If there's an additional $6,000 deduction, let's see how that impacts your after-tax dollars. For many of you on the call, and for especially our previous one, we've had a chance to run a tax analysis of reviewing your 1040 and 1099s to see, does it make sense to do your standard deduction or should we be considering itemized? And then conversely, with this additional 6 grand, we can project out if your income level stay the same, how might this impact your after tax, your overall net income? Jason, anything you'd like to add?
Oh, great point with the standard deduction, right? As you get this additional amount and it raises the limit, it really is going to affect, hey, maybe I don't itemize. Maybe I hold that off until later when I can get that big clip off the itemization because now with it being temporary, you know it's going to end. So just kind of thinking through more than just what's happening to me in the coming year, but what's happening to me more like in a 5-year frame.
Oh, well, I think we'll be talking about this in a minute, but also it might make sense to balloon some of your gifting from whether it's a church or charity. Balloon it in one year, you itemize this year, but then the next few, you're able to take the standard deduction. But that's a conversation for another point. Sorry, Matt.
No, no, you're good. You're good. Keep it going. Keep it going. We're gonna, like you said, Ken, we're gonna jump into it. Um, so some of the impact then, it could reduce your potential IRMA. Don't forget, IRMA is the means testing for Medicare purposes. What that means, pun intended. What that means essentially is IRMA operates on a cliff system. So you go a dollar into the next bracket, you're in the next bracket. It's not a progressive system like income tax. So what that additional deduction, like when Ken and Jason were talking about in terms of itemizing and some of the strategies you're going to pursue, it might give you a little additional cushion to minimize the impact of some of those strategies, not just in today's tax dollars, but in terms of the impact they're going to have on your Medicare premiums. Could it result in lower Social Security taxation as well? Sure, we talked about that. But again, the formula for Social Security, the formula for IRMA did not change in this bill. So Ken, this gets right into what you were talking about. So great preview. Um, you know, Ken and Jason, do you want to talk a little bit about, elaborate a little more on the whole accelerated Roth conversions, the drawdowns, timing your RMDs even?
I mean, let's be clear, an extra 6 grand deduction isn't going to create a huge additional space to do Roth conversions, but it is going to make it cheaper. So no ifs, ands, or buts. So if it's part of the strategy, it's something worth exploring. But it's going to make an impact on all your different accounts. And I really like that second bullet point, the strategic drawdowns from taxable accounts. If we are trying to spend down our IRAs, that just means we get 6 more grand out of that account without any consequences or unexpected taxes. So take advantage of it. Jason?
And I would say the third bullet point, timing of RMDs, is critical because what we've seen and what a lot of professionals have seen is this amassing of 401k wealth, and they told us save everything you can pre-tax, and now you have a gigantic bucket of wealth that requires RMD distribution, and you have no control over how much you get to take or how much you have to take out. So really contemplating, hey, maybe I should start working on that bucket and getting it down some before I actually have to take it down per government rules. So we do a lot of that.
All right, we touched on Medicare already, modified adjusted gross income, and some of the marginal brackets. Let's get into estate and wealth transfer. So the standard exemption went up to 15 million per person, which means 30 million for a married couple. It is indexed for inflation going forward. A lot of people will see this and say, well, my wife and I or my spouse and I are never going to be worth 30 million. So why would we even think about estate planning? Don't forget two things. One is, first of all, everybody should have an estate plan, because if you don't, your state has rules that your estate will have to follow. So you should have a will, you should have a trust, you should have a medical directive, you should have a power of attorney in place. The second thing is, a lot of you have done really well and you're going into retirement with, couple million, 5 million, 10 million, whatever the number might be, and you have a really, really good income plan that we've built for you. And what that really, really good income plan means is you're not drawing assets out of your investable accounts at the rate you would be if you did it the way most financial advisors would set you up. What does that mean? That means that those accounts are going to grow over time. And if they double or quadruple in value by the time you both pass away, all of a sudden you might be right in this range. So this is something that you want to think about from a, hey, we might not be there today, but I still need to have a good estate plan. But then B, I might not be there today. That doesn't mean I'm not going to be there at some point in the future. So Jason, do you want to elaborate a little bit on just some of the gifting, the trust planning, and the charitable planning that people might want to start thinking about? Especially if they're starting to think long term about their plan.
Definitely. I would also say on that last slide is that one of the things, yes, while federal may be high, the thing to consider is that not all states follow the federal guidelines.
Yeah, that's a great
So
point.
Matt used to live in New Jersey. New Jersey was not federally compliant. They did what they wanted to. They set up their own exemption limits and said, hey, you're going to pay if you're over a certain amount. So there's many states that do not follow this guideline from that end. Luckily, Texas is one of the ones that follow it. So we live in Texas, so we're pretty good. California, I can't remember off the top of my head, but
there is no estate tax in California. So
great.
yeah.
So
Yet.
Yeah.
lucky,
Yet.
right?
Yes.
And so another thing to keep in mind
Yeah.
is that these things are very fluid. Obviously, we've had, on average, the tax bill has the tax landscape has changed every 18 months. So change is pretty normal at this stage.
Jason,
Yeah,
can I riff on that real quick?
Sure.
So a decade ago, the exemption was 5.4 million. A decade before that, it was 1.5. So you can take one of two things from that. Either one, it's quadrupling every 10 years. That's true, technically, but more importantly, it can change drastically in just a decade. And most of you here have 2 to 3 decades. We'll be talking about more about some of the tax consequences about this, but just as high as it is today, and as much as it's gone up, there's a very strong chance it could also go down. And so while it does say permanent there, that just means it's not scheduled to change. All the next administration, the next Congress could easily move these numbers. So it's changed a lot in just the last 2 decades. How is it going to change in the next 2 decades? It could very well continue to keep going up. I just don't know that's the case.
yeah. Thanks, guys. Um, so you still need a plan, right? And when we get into gifting and so on, um, Jason, do you want to break down a little bit about how gifting really works, um, and what that can mean, in terms of, getting dollars out of your estate now?
Definitely. If you're one of the several families, many families really, that we see that have excess because you have more than you're going to be able to spend over your lifetime, you can do these annual gifts of $19,000 per person. And the per person is any person from that end, just to be clear. So that means I can give 19,000, my wife can give 19,000. So together we can gift as a family $38,000 to any person. Great for getting those excess assets out of your estate. The other thing too is, we talked about that 15 million. Oh, Matt, I don't have to worry about that 15 million. I'm not worth 15 million. Well, there's an exemption that you can use, which is worth 15 million, which means technically I could take a million and gift it today into a trust that could be for the benefit of my kids and grandkids and not worry about estate tax on those monies for that period of time, right? For the kids and the grandkids' life. So when these opportunities come up like this, there are some strategic things that we can do to really take advantage of them.
All right. So don't get complacent. And like Ken said as well, federal rules could change. Now, I know, Jason, you do a lot of work with donor advised funds and especially charitable remainder trust. Do you want to give everybody just a quick overview on how does a charitable remainder trust work? They put money in, what happens? How does it typically work? How does it benefit someone?
Yeah, so a charitable remainder trust is just a way for a person to give to charity when they don't need the funds anymore, which is typically when you passed away, but also get an income while you're living and then get a tax deduction today when you fund the charitable remainder trust. So they're going to, charitable remainder trust is going to get set up. It's going to be its own taxing entity. So you're going to file a tax return for it. You're going to put money in it. The IRS is going to say, how much money are you taking out and how much we think is left for the charity at the end? And they're going to say, what's that value worth today? And they're going to say, okay, that's the deduction you get. So those work really well when there's an income gap. You need a charitable deduction. You're going to do a big Roth conversion.
All right. So this helps you align taxes with your long-term goals, right? Because we do hear a lot of different things from people. A lot of people want to maximize not only their impact on charity, but to their family. Some people say, hey, you know what? I don't really care. They're going to get what's left over, right? There are strategies for you in either direction. So the salt reduction or deduction, this was a big deal. So there was a lot of debate especially in the House about this. And the reason this was a big deal, I know we have a lot of people from California on the call, so you'll appreciate this. Um, in some parts of the country, as you all know, property values have just exploded in the last 22 years, especially since interest rates went down. As a result, so have property taxes. And so you could be living in an area where someone's maybe a firefighter and the other person is a nurse, and they've got decent income, but they're getting crushed every year in property taxes. So the SALT deduction was raised to $40,000. Income does have to stay under half a million. It gradually phases out above that. But again, this is only for the next few years. This is temporary. This is scheduled to go away. So this will be a debate that's going to come up again in the next few years. Um, Typically with this deduction, and Ken and Jason, I know at the on the earlier webinar we did today, you guys talked about this a little bit. Um, with the deduction, again, it raises the question, are you itemizing? And so do you guys want to talk a little bit about that? Because some people are be like, oh, my property taxes now, but what's, what's the potential catch here?
The big potential catch is actually what you said, the itemizing versus standard deduction. Because the standard deduction's got so high, sometimes people are just rotating. They'll say, okay, what happens, Matt, if I pay my property tax this year at the end of the year and my property tax for next year at the end of this year? Then they bunch it, right? You bunch both of those taxes together so you have more itemized in that one year, and then you can itemize that year. And then next year you say, you know what, we're doing standard. And you kind of keep that rotation going so you can get the most out of the tax code and what you're able to do.
Yeah, yeah, it's a great way to look at this. And folks, if you're looking at how do you structure things to be able to make that payment, talk to us because it's just a matter of, making sure we know where the money's coming from and given on what it might be going on in the market. Are we taking it out of the right account? Are we looking at capital gains taxes? Are those short or long term? Have a conversation. Like if you want to pursue that, just have a conversation. Tips and overtime pay. These are temporarily tax-free as well. This is only going to be in tax years 26 through 28. The phase out on this is for a single person starts at 150,000. The joint is 300,000. So, guys, we're switching to a tip-based income
Right.
for ourselves, right?
This is
So,
this is probably one of the most generous parts of this legislation. I mean, even when you get over the phase out, it's only $100 reduction in that $25,000 amount for joint filers per thousand above it. So it's going to take you a bit to exit the whole $25,000.
yeah.
I'm telling you, it's a trap. They're just trying to capture data of people willing to report what their tips are and get it tax free, so now they have a better idea of what tips actually are. But
Yeah, of
yeah,
who's making what. Yeah, yeah.
yeah.
There you go. Um, all right. So moving on here. Auto loans. Okay, this is an interesting one. So people see this and they're like, "Ooh, I could buy a car this year and have, and pay a high interest rate and then get the whole thing deducted." Okay, a couple things you gotta know. You have to buy the car of basically January 1 of this year going forward. Two, it has to be a new vehicle. And three, it has to be a US assembled vehicle. The way you're going to figure out if it's a US assembled vehicle, you have to have a VIN that starts with a 1, 4, or 5. That typically tells the DMV and all that it's a US assembled vehicle. So it's temporary and it's got a really low phase out. The phase out starts at 100,000. So if you're going to buy a new car, you think you're going to take advantage of this, remember, it's got to be US assembled, it's got to be brand new, but there's a relatively low phase out on this. So, but this could benefit people as well. QBI, as a business owner, this is the pass-through deduction for qualified business. It's going to stay at 20%, but it's permanent. Jason, as a business owner, by making this permanent, how big of a deal is this for people, for
This is
business owners?
a huge deal for sure. Like the 20% is massive. I mean, when you think about it, all of the businesses that we serve and them having this profit and then getting an instant, hey, keep 20%, Matt. We're not going to come after that and charge you a tax on that. We're only going to tax the 80%. When they were actually thinking about this coming off, it was a lot of talk from the lobbying associations that support the business owners because this is a big deal for them.
Yeah. And so is the next thing, bonus depreciation.
Yeah, bonus depreciation. This is huge, huge, because the TCJA had the bonus depreciation decrease. Now, what was it 100%? They go down to 80 and 60 and so forth and so on. With them bringing it back to 100%, think about the small business owners like a dentist firm, the doctor firm, to pick on some of the medical guys that use equipment. You sit in their equipment, you see their equipment being used on you, right? being able to take a full deduction the year you bought that equipment, that's a pretty big thing, as opposed to, hey, Matt, you had to buy $100,000 piece of equipment and you have to spread it out over 15 years. Which would
Hmm.
you prefer?
Yeah, to get it all, right? Get it all up front.
Right.
Um, and then that also applies to, well, R&D costs, right? Full
Yeah.
expensing right away, right?
Oh yeah, which is, I mean, massive for the organizations that do R&D from that end. R&D is extremely particular though, and what classifies as R&D. So when working with this and the prior one, there's typically a program that we use to make sure that you qualify for those things.
And we can take people through that, right?
Yep.
We absolutely can. So if you want to participate in that, or you want us to go through that with you, just let us know. Just
So,
let us know.
Jason, is only heavy equipment or technical equipment able to be accelerated, depreciated, or what are some of the other assets that could be accelerated in regards to depreciation?
And it could be printers, chairs, desk. Um, I mean, technically, every piece of a house can be itemized into a list of what its depreciable schedule is, from your doorknob to your sheetrock.
So even that new car they bought with those special deductions, they can
Yep.
accelerate that. Okay.
Even that, if it's for business, right?
The rental properties for business.
Yeah, it's going to be a
Just,
bonus depreciation. Yep.
okay, right on. But they need to be itemizing at that point, correct?
Yes. You
But
definitely want to be itemizing.
that comes back to the point of maybe this is the year we do the remodels. This is the year we buy the work truck. We do all that. We accelerate it. And then next year going forward, we now focus on the standard deduction and reap those benefits. Is that fair to say?
That is fair to say, Ken. And I would also add to that from a charitable perspective, they did put this odd little piece in here that says even on charitable gifts for 1,000 and 2,000 for joint filers, that you can do it without itemizing.
Okay.
So it's pretty nifty thing. They did it to make sure that people don't stop giving to the small amounts to the causes.
I was trying to find an excuse to stop, but I guess they found.
We
Ken,
stopped that.
Ken, you're one of the most generous people we know. I don't believe for one, I don't believe that for 1 second. One
You
second.
know I only get for the tax deduction, Matt. Come
Oh,
on.
of course. Yeah, that's you. That's absolutely you. Um, okay, Jason and Kim brought up these issues, right? Should you accelerate your equipment purchases? I think the answer is a resounding yes, if you can. Make sure you're maximizing the qualified business interest or deduction, excuse me, and R&D expenses. If you're not sure what qualifies for that, make sure you have a conversation with us. We can help you navigate that. Okay, social programs. So this gets into some of the costs. There were some Medicaid work requirements that were accelerated. Some people could lose coverage, but what you're seeing with SNAP is parents are only exempt from work requirements if the child's under 7. Some of the Medicaid cuts, the child has to be under 12. From a Medicare standpoint, legal immigrants might lose access as well. The key there is they're legal immigrants, so this could be like people in a refugee status, something like that. So this isn't broad. We'll see what the impact is on this. We're not entirely sure at this point. So in balance, the bill, it does help estate and businesses. It absolutely does. Some of the safety net programs, you're going to just want to make sure you understand how that really works, especially, and someone you may know who relies on those programs is going to want to understand how their benefits may change. Fiscal impact and political outlook. So this is always a tough one for me. I've always been kind of a deficit hawk just by nature, and so I see the CBO finally landed on a number. Some of the numbers were much higher than this 2.4 trillion that they finally landed on. But essentially what they're saying is 2.4 trillion in new debt over 10 years. The argument in favor of the bill is that the amount of business and additional revenues this will generate, not just for business owners, but also for the government, will more than offset the cost of this bill. Let's hope it's right. Let's hope that's actually how it works. The other thing they did was they did a $4 trillion increase in the debt ceiling. So it should be a while before we see any more drama about the debt ceiling and, oh my gosh, the government's going to whatever, right? So hopefully it's a while before we have to see any of that in the news. Okay, so I'll break this down or I'll kick it back over to Ken and Jason here. Guys, what should everybody be thinking about now? I mean, this just came out. This is 26 days old, right? What should people be doing now?
So I'll go ahead and kick it off. The first thing they got to do is understand where you're at. So over the last, call it 6, 9 months, we have really elevated some of our tax analysis tools and resources. Use us. So I know back in March and April, there were some emails going out to our existing clients that we can do this analysis. Many of you took advantage of it. Guess what? We should probably do it again. Now that we know this is the case, and especially for some of our seniors, there's that additional tax credit, or increased standard deduction. Let's take a look at it. Let's talk about it, especially now that the estate plan is permanent, big ol' air quotes. Let's see what the implications are. And let's play around. What happens if it goes all the way back down to the 5 million mark that it was a decade ago? Are you impacted or not? But again, these are just, we love to turn over every stone and make sure you're protected, and we're not leaving any strategy on the table. But all it takes is a quick conversation to really figure that out. Jason?
Yeah, and I would say, evaluating deductions, credit, and estate plan, and just your planning in general. I mean, realize the stuff we covered is the high points of this bill. There's other little minutiae that in there has to do with deferring capital gains and other things like that that are involved in this that fall into what you're trying to do as a person in regards to what you need, what you want to do for your family, what you want to do for your community, all of those things. Let's use all of it to get you where you want to be.
Yeah, and to layer onto that, folks, the tax system is the tax system. Um, the rules and all that are in place for you to use them. Use them. Absolutely use them, right? There is no reason for you not to do this. And that's something that working with us, getting, like Ken was saying, get some of the analysis done. Like Jason was saying, start thinking about how might this, ask the question, how could this apply to me? What could it mean for me from a gifting, from a charitable, from a estate planning standpoint? And it might not even be the $30 million estate. It might be, how do I make sure my grandkids get the most possible after I pass away, right? It could be something as simple as that. So review the plan together. And like Jason and Ken were both saying, take advantage of the current opportunities, especially while they're there. Don't procrastinate on this. Are you protected against future risks? Okay. I know we spend a lot of time talking about taxes, but how many of you have had, say, your insurance reviewed in the last 6 to 12 months? How many of you have actually had someone sit down and say, hey, you know what? Your income and your investment portfolio, here is how they're working together to generate the lifestyle you want, and then taking that analysis and applying it to this tax situation. A lot of you may not have done that. I know we have some people on the phone who are not clients of ours. You're going to want to have a conversation with us about about how you can do that. And it's real easy. Just get a hold of us. Let us know. We will follow up with everybody who was on the call by the end of the week. Absolutely. But stay informed with this, stay proactive, and let's keep reviewing your strategy to make sure that it's taking advantage of some of the new opportunities that you have available to you.
Matt,
Ken, yeah, go ahead, guys. Last thoughts.
la absolute last thoughts. Probably not. We'll see. But I think my last thoughts. So March is when they announced the tariffs, and there was all sorts of volatility. From the bottom at the end of March, early April, the market's up 24%. We're back at all-time market highs. But inflation is starting from when those tariffs were announced. Beef is up 15 some odd percent. Lumber is up 30%. I'm not one to read the tea leaves on what's going to happen in the market in the next 3 months, but there's plenty of reason to believe volatility might be there. So one, it might whether the market's up or down, it's neither good or bad as long as you have a long-term approach. So let's level set on that. If the market's down, we had a handful of clients back in March do some Roth conversions. Well, guess what? Those new Roth accounts are up 24 some odd percent. They basically washed out all the taxes that they just paid on those accounts. Not a bad place to be 3 months later. With that being said, if there's volatility that comes, what is your strategy? Let's talk about it. Let's figure out, should we be doing Roth conversions? Or if you're concerned about the volatility, what are some of the ways that we can lock in some of those gains and harvest and keep your principal where it's at? Again, whatever happens is neither good or bad as long as we have a strategy and you have control over what happens next. But let's have a conversation. I'm going to throw our contact links in the chat. Uh, don't hesitate to reach out, schedule a 15-minute call, and let's catch up. Jason?
Oh, valid point. The pre-plan is everything, right? A lot of this stuff doesn't come in effect until 2026. So getting ahead of it and being ready to execute when it becomes available is critical. I mean, with the temporary components they have as a plan, that is going to be very time sensitive. So we want to be on top of that. We want to get things moving. Let's use as much of this as we can before they change it again.
All right, guys. Are we sure those are last thoughts? All
Oh,
right.
well,
Oh,
actually,
Ken's
let's
got one more.
talk a little
Okay,
bit more about the cars. Those have to be assembled in the US, right?
that's correct.
And they have to be made from 2005 to 2018, just like those Trump accounts. So kids and babies need to be made in the next three
Well,
years.
they don't have to, the cars don't have to be made. They have to be able to prove that they were made in the US, and the purchase of the brand new vehicle has to occur in 2025 or later.
So it could be a 2024 that's just sat on the lot.
Could, could potentially. So,
Okay.
yeah.
Go shopping, everybody. But so again, there's just some nuances. If any of these ring a bell, let's talk.
All right. Hey, thanks everyone. Thanks for making time. One last thing, Ken, was there a common theme to any questions that came in tonight while we were doing the workshop compared to some of the questions we had earlier today?
Pretty calm overall tonight. Earlier today was just more so around the standard deduction versus the itemized deduction. But again, that's where our software comes in play and just one of our analyses that are available to all of our clients.
All right. Thank you, Ken. Thank you, Jason. Thanks everyone for making time to join us. Hopefully this was informative. Please reach out to us if you do have any other questions. For those of you who maybe heard about this on LinkedIn and joined us there, send us an email, go to our website, hit the contact us page. We'd be happy to have a conversation with you. Thanks again, everyone. Have a great night, and let us know if you have any questions. We'll talk to you all soon. Bye-bye.